Welcome back, everyone, and thank you for joining the channel. Today, we are taking a deep and detailed look at Applied Digital, trading under the ticker APLD, a company that has rapidly become one of the most debated battleground stocks in the artificial intelligence infrastructure sector. Right now, the stock is sitting directly in the middle of a major debate between aggressive AI bulls and cautious investors who are worried about leverage and balance sheet risk. Over the past 24 hours, APLD has been attempting to stabilize within the $27.40 to $28.50 trading range. This price action follows the company's massive $2.15 billion senior secured notes offering that carries a 6.75% coupon and officially closed on March 10th. At the moment, the market appears to be in what many analysts describe as a digestion phase. Investors are trying to determine whether this enormous capital raise strengthens the company's long-term growth story or simply increases the financial risk attached to the business. On the positive side, the company now has the funding required to move forward with the construction of the Polaris Forge 2 AI campus in North Dakota. This facility is a cornerstone of Applied Digital's long-term strategy and is closely tied to a massive 15-year revenue pipeline estimated at roughly $16 billion, connected to its partnership with CoreWeave. However, the other side of this story is the balance sheet. With the new financing completed, Applied Digital's total debt load has now expanded to more than $2.6 billion. This dramatic increase in leverage has created a clear divide in investor sentiment. Some investors see the capital raise as a necessary step to secure a dominant position in the future AI infrastructure market, while others view the rising debt burden as a serious risk if revenue growth fails to materialize quickly enough. Recently, we saw a modest recovery of around 1.4% during midday trading, suggesting that some buyers are still stepping in at current levels. Yet the memory of a major event from last month continues to influence market psychology. Nvidia's complete exit from its roughly 7.7 million share stake in Applied Digital still casts a shadow over the stock, and that development has made every price movement feel significantly more dramatic. As a result, the market currently reflects a classic tug-of-war between the enormous long-term vision of a multi-gigawatt artificial intelligence infrastructure future and the very real financial challenges associated with building and financing that vision. When we shift our attention to the technical charts, the situation becomes even more interesting because the stock now presents a textbook example of oversold resilience. At the moment, Applied Digital is trading below its 50-day simple moving average, which sits near $32.68, and has now transformed into a strong resistance level that the stock must eventually reclaim if bullish momentum is going to return. At the same time, the share price is hovering very close to the 200-day simple moving average, around 28 to 13 cents. Many long-term investors consider this level to be the true line in the sand because holding above it often signals that institutional investors are still supporting the broader trend. The relative strength index has also recently dropped close to the 30 level, which traditionally signals that a stock has entered technically oversold territory. Historically, Applied Digital has demonstrated a pattern of producing sharp rebound moves from these types of conditions. In some cases, the stock has produced what traders call a dead cat bounce, while in other cases the oversold signal has marked the beginning of a more substantial reversal, particularly when broader artificial intelligence sector news acts as a catalyst. From a support perspective, the most immediate floor currently sits near the $25 level, which has already been tested several times during the week. If that level fails to hold, the next significant technical support does not appear until roughly $21. On the upside, the bulls would need to push the stock through a high-volume breakout above approximately $29.40 in order to invalidate the short-term bearish trend that has developed over the past several weeks. Another factor that traders must consider is the extreme volatility profile of this stock. With a beta of roughly 7.20, Applied Digital is more than 7 times as volatile as the broader market. That level of volatility means price swings can be dramatic and rapid. This is clearly not a stock designed for conservative investors. Instead, it represents a high alpha opportunity where momentum indicators may signal potential buying opportunities, while fundamental metrics such as the debt-to-equity ratio, currently near 1.79, simultaneously warn investors about the risks associated with heavy leverage. Looking beyond traditional financial analysis, it is also worth examining what the social media investing community is saying about the stock right now. On the platform X, where much of the retail trading conversation takes place, sentiment surrounding the hashtag APLD has become sharply polarized. Bullish commentators are pointing to broader developments within the AI infrastructure ecosystem. In particular, many of them are highlighting Nebius receiving a $2 billion investment from Nvidia, and arguing that this represents a positive signal for the so-called neo-cloud sector. Their argument is that if the overall AI computing ecosystem continues to expand, then large-scale data center infrastructure providers like Applied Digital could end up controlling some of the most valuable digital real estate in the world. However, the bearish voices on X are focusing intensely on what they describe as a hidden weakness within the company's growth pipeline. Their primary concern revolves around customer concentration risk connected to the CoreWeave relationship. Critics are warning that if construction timelines at the North Dakota Polaris Forge 2 site experience additional delays, certain partners, including Oracle, may possess termination rights within their agreements. That possibility has raised concerns about whether the projected long-term revenue pipeline is as secure as it appears. There is also a great deal of discussion surrounding the company's short interest. More than 80 million shares are currently sold short, which has many traders speculating about the possibility of a short squeeze scenario. If upcoming financial results were to show stronger than expected progress, particularly if the company reports a narrower loss than analysts anticipate, a sudden upward price move could force short sellers to cover their positions. This dynamic has led a portion of the trading community to focus heavily on the upcoming earnings report scheduled for April 13th. Among professional analysts, the consensus rating remains relatively neutral. Many analysts currently classify the stock as a hold, often represented by a Zacks rank number 3 rating. However, price targets remain surprisingly ambitious, with certain firms such as B. Riley previously suggesting that the stock could potentially reach levels near $53 if the long-term infrastructure strategy successfully materializes. So, the final question becomes straightforward but extremely important for investors trying to decide how to approach this situation. What exactly is the strategy here? For short-term momentum traders, the approach is relatively clear. They are watching closely for a confirmed bounce from the $25 support zone and would likely target a move toward the $32 resistance region where a technical gap exists. Long-term investors, however, must consider a much broader strategic question. They must decide whether they believe Applied Digital can successfully execute its ambitious AI factory vision before the financial pressure created by its growing debt obligations begins to weigh on the company's balance sheet. Over the past 6 months, the stock has already demonstrated the type of explosive upside that attracts speculative capital, with a surge of more than 60% at one point. At the same time, the 19% drop that occurred in February serves as a powerful reminder that the risks associated with this investment are very real. If the company manages to close the current trading week above its 200-day moving average, many market participants would interpret that development as a signal that institutional investors may be accumulating shares again. Investors are also closely monitoring any updates related to hardware deployment because those announcements will directly influence the timeline for lease commencements at Applied Digital's data center facilities. For now, the most critical date on the calendar remains April 13th, when the company is scheduled to release its next earnings report. For many investors, this will be the next true make-or-break moment that could either reinforce confidence in the company's long-term artificial intelligence infrastructure strategy or intensify concerns surrounding its highly leveraged growth model. If you found this breakdown helpful and want to stay updated on the latest developments in AI stocks, technology investments, and market analysis, make sure to like the video, subscribe to the channel, and turn on notifications so you never miss our upcoming content.